Well, Canada's inflation is proving to be one that is felt certainly stateside as inflation creeped up. You saw skittishness in the bond market, in the currency market. Equities are even under pressure right now, and I've seen some traders attributed that to the moves that we saw, because when you see this rising inflation on the back of energy prices and crude at $93, it has people wondering, how are central banks going to react? The Federal Reserve will be a key test of that, sitting down for a two-day meeting that begins today. Decision is tomorrow. Now, there's no expectation they're going to increase rates at this meeting. However, pricing and odds of another rate hike and of higher for longer have started to creep more emphatically into the market. Let's bring in Danielle DiMartino Booth. She is the CEO and Chief Strategist for QI Research, former advisor to the Dallas Fed. Danielle, thank you so much for joining us. You know, the number one question right now is, how big of a problem is rising oil prices for those trying to put the inflation genie back in the bottle? How are you thinking about answering that?
Well, I think that Chair Powell's really going to be pressed on the subject when he's at the podium. He has been focusing investors' eyes on what he calls super core, which is it's inflation, core inflation, net of shelter. So you're not really seeing energy reflected there at all. But of course, all sights are on the prices at the gas pump that Americans are suffering, that Canadians are suffering, that we saw with upside in Canadian inflation this morning. So now we see, is there going to be a narrative shift? Is he going to say, you know what, I'm moving from just looking at the super core, the stickier forms of inflation, back to saying this is something very real for households, and it's causing them a lot of household stress, household budget anxiety, especially when you consider that wage growth has been slowing and joblessness has been increasing.
You bring up an interesting point about sort of that oil picture, and I want to counter that with, and maybe it's stale, but the University of Michigan came out last week with inflation expectations, and that hit a 2-year low. So there's tension there, right? It's like, we're looking at these rising gas prices, but if you're trying to manage expectations, they're moving in the right direction.
You know, they are moving in the right direction, but part of that is weakening auto sales. Part of that is weakening home sales. And part of that is weakening purchases of durable goods. All three of those households in that University of Michigan sentiment survey, they said that the buying conditions have worsened appreciably. My concern is that households are substituting. They're saying we've only got so much in the budget, so we're going to have to buy less of what we want to buy, because we're going to have to spend more on what we have to buy. The roof over our head, the food on the table, and the gas in the gas pump, especially as more and more companies are saying to their employees, you know what, it's time to get back to the office. So we've got commuters all over again spending more than they were right after the pandemic struck.
So where's your conviction right now on the path of rates going forward?
Well, look, we just saw 2 fresh bankruptcies hit this morning. These high rates really are biting into economic growth. They're biting into the labor market. And at some point, you have to say, are these high rates breaking the economy? And that is why we begin to shift the discussion to, are there going to be rate cuts in 2024? And again, you mentioned the word tension, friction, you know, with rising gasoline prices. Will there be pressure on central bankers to keep increasing interest rates that are, by the same token, breaking other things in the economy? This is the conundrum that is introduced in a stagflationary environment, one that right now Europe is suffering to a much greater degree than we are across the pond.
And yet it's sort of not a done deal that slowdown is taking hold. You see it in pockets, but then the services sector, you know, through the ISM is showing that it is still very much trucking along, and job growth remains robust.
You know, it's interesting that you bring up the services sector. The state of New York, its economy depends more on the services sector than any other in the United States. We use it as a proxy for the services sector. And we saw fresh data. The September services survey out of the state of New York yesterday show extreme weakening in the services sector. So I suspect that even services right now is a ticking time bomb. Remember that Americans, quite a few Americans that don't qualify for student loan relief have already begun to repay those loans in August, and they're saying that they're cutting back in luxury type of spending. I'm not going to spend as much on travel. I'm not going to spend as much going out to eat because I've got this extra line item that I haven't had to pay for 3.5 years now. Add it back into my budget. So I would be very careful about looking back at the August services ISM and look forward at the biggest services state in the nation.
So it sounds like, if I'm hearing you correctly, that if the Fed were to take a more hawkish tone because of rising oil prices, that would be a policy mistake.
I think at this juncture that there are so many cross currents that the Fed is correct to be pausing tomorrow, but they really do need to see what the next employment report is going to be, as opposed to being so focused on energy prices. I understand that they're very detrimental and harmful to U.S. households, but they really need to see how much damage a higher for longer interest rate environment has done to the U.S. labor market.
I know this is the question that is sort of on every policy wonk's mind, but when you mentioned the prospect of rate cuts, it's, rate cuts to what? What is, that R-star, that neutral rate, and this idea that we're not going back to zero, and it's somewhere in between 0 and 5.25.
Right. No, I think you capture very well, especially Chair Powell's philosophy. And I don't think that he has it in his mind to go back to the zero bound. And that is the crucial question going forward, is even if we see rate cuts in 2024, are they going to be very small, very incremental, not what a lot of investors have become accustomed to over the last 30, 40 years? Is it not going to be dramatic on the way down? And by the way, will the Federal Reserve continue to deplete liquidity from the financial system, which we are seeing manifest in the highest bankruptcy cycle since 2010 by way of continuing to shrink its balance sheet, pulling liquidity out of the system? That's exactly what Powell has suggested can take place in 2024. Yes, we'll give you rate cuts, but I'm going to continue to shrink the balance sheet and to take liquidity out of the system.
All right.